Difficult one.
Hello, I'm Harry Driscoll, Senior Research Analyst at Chelsea. I'm joined here today by William Littlewood, the manager of Artemis Strategic Assets. The fund has been on the Chelsea selection since just after its launch in 2009 and was promoted to the Chelsea core selection in 2011. William, perhaps you could start by telling us a little bit about your investment process.
Sure. So we have 4 asset classes we look at, which are equities, bonds, currencies and commodities. And the objective of the fund is to try and grow the assets as safely as possible. So we have one half of the fund is trying to protect assets and one half is trying to grow. And looking at those assets in more detail, the equities we can invest in are mainly UK and US equities. And that's because that's where my longest experience comes from. But we also invest in some big global companies like, say, Samsung and Nestle. The bonds we're looking at, we don't like bonds right now, but if we did buy bonds one day, it would mainly be government bonds, so UK or US or European government bonds. We actually have a very small position in a US index-linked bond. And then currencies, we can go long and shorter currencies. We can buy one and sell against the other. So, for example, we have a lot of Asian currencies which we are long of, and we are short or expect the other currency to go down, so say the euro and the yen. And then there's commodities, which we're mainly investing there in precious metals, particularly in gold. So it's not really, you might think it's a sort of multi-assets fund, but it's a fund really, I would call it an equity-dominated multi-assets fund. If we don't like, say, bonds, which we don't, we won't hold them. But equities we'll always hold, and we do.
You have some pretty strong views on the long-term consequences of quantitative easing. Would you mind sharing them with us?
Sure. So quantitative easing came in 2009, I think, in the UK and the US, and it was really an emergency response to emergency times. Because you remember back in 2009, no one really quite knew where we were going, and we were staring at some sort of economic abyss, and the policymakers didn't know where we were going. So they came up with this policy of what they call quantitative easing, which is really, in my view, is money printing. And I think broadly it was successful in the sense that we didn't fall through a great big hole, because back in 2009 it did look a bit like the 1930s. But interestingly, we're still employing quantitative easing. So Americans have now printed about nearly $4 trillion. In the UK, the British government has printed £375 billion. But what they've done mainly with this money, especially in the UK, is to buy government bonds, which has done 2 things. One, it has suppressed the yields in government bonds, but it's also enabled governments to carry on spending way in excess of their taxation revenues. So they've become almost institutionally profligate in some ways. And the history of quantitative easing or money printing is a very poor one. There are very few countries out there which successfully used quantitative easing and got out of it eventually without trouble. And what usually happens is eventually you get some form of inflation. And I think because the politicians are so addicted to quantitative easing, because I say it makes it easy for them to spend beyond their means and spend money they don't really have, I think we'll see quantitative easing as a standard policy going on until something goes wrong. And history shows that eventually that what goes wrong is you get inflation. And I think that is eventually where we'll get to.
You've mentioned your concerns about debt levels in Western economies, in particular Japan and the UK. With that in mind, do you think that the economic revival in the UK has perhaps been overplayed?
It's quite hard to work out where the UK goes from here. Relatively speaking, relative to the rest of, say, Europe, I'm reasonably optimistic about the UK, but that's more a long-run issue in that we have our own currency. Even something like the British language is helpful for the UK. A lot of people still want to come to this country because there are good reasons here why so many immigrants want to come to the country, because it's a successful country. So is it going to carry on growing at the rates we had in the last 6 months or so? I think in the short run it probably will. Can it do that sustainably forever? I don't know. I've got grave doubts about the housing policy the government's got, in the sense that they're encouraging people to borrow money to just finance the deposit in the house, and that looks to me potentially quite dangerous in the long run. But in the next year, I think the UK economy will be fine.
Taking all that into account, how is the fund currently positioned?
So right now in equities, we're about 50% invested or net invested in equities. So that means if equities go up by 10% and we have an equivalent basket to the index, then this fund will go up by 5%. So but equally, if equities go down, we'll have some protection. And to give you an example of where that is in my sort of historic leanings, the highest equity position we've had has been in the low 80% level, and the lowest we've had is 48%. So we're at the cautious end of that. But if equities went up further from here, I would probably get even more cautious. So we could get more cautiously positioned if we need to. We've got about 10% in precious metals, mainly gold and platinum, which I'm optimistic for. And in fact, I'm surprised that gold prices have gone down so far, given the backdrop of huge quantitative easing or money printing programs around the world in governments. And other reasons for buying gold will be interest rates are low, which is a good thing for gold. Real interest rates are negative, which is again good for gold. And actually, I think in the long run, there will probably be more wealth taxes across the world. I think, and in that case, people will look for gold. I think. In terms of currencies, as I said, our big currency position there is we're long of Asian currencies mainly. So our big position would be in the Singapore dollar, and we have quite big positions in Taiwan dollar, Hong Kong, and Malaysia, and we're short or balanced by positions in the euro and the yen especially. And my view here is that on any long-run view, 5-10 year view, I expect the Singapore economy to grow faster than Europe or Japan for a lot of reasons. And if there were a proper sovereign debt crisis in the West, which I expect at some stage, Singapore would look very, very strong because they won't have any form of sovereign debt crisis. They've got huge government assets. And just bonds, you can probably tell I'm very gloomy on government bonds. We are short of government bonds, as I said, so we expect the price to go down and to benefit if the price goes down. And our biggest positions there is in Japan, where I just think the fiscal situation there just looks horrific.
This interview is being filmed in December, and given what you've said, am I right to assume that your outlook for 2014 is somewhat more gloomy than other market commentators?
That's probably right. There are two things worry me about equities, which is the bigger part of this fund. One is if we have a sovereign debt crisis in the West, which I'm absolutely certain we will do one day, because take a country like Japan, for example. They've got a huge amount of government debt there, which is growing every year by quite a large amount. The population is diminishing. They're printing money to cover up the difference. I can't see that sort of policy successfully enduring. And if you have a big spike in government bond yields, which I think is likely and would be the consequence of a sovereign debt crisis, then shares will do really quite poorly as well. The second issue which worries me a bit about shares is that profits are very high in particularly the Western world, and profits as a percentage of GDP is a mean reverting indicator, which means that if it gets too high, in the end, the profits are competed away and they go down again. And what you know for sure now is that if profits are very high, there's only probably one direction in the end for them to go to, which is at some stage down. So those two reasons make me cautious. But for this fund, there are things we can do to counteract that. So I'd expect the outlook for commodities to be pretty good, because quantitative easing should be good for precious metals. The currency positions we have, where we've got big positions in Asia, I think will do well again under such an environment. And because we are short of government bonds, which means that we expect them to go down in price. We will gain if government bonds go down in price. And if that would happen, this fund will do well. So actually, I'm more pessimistic for the world than I am for this fund.
William, thank you for your time today.
It's a pleasure.